Okay. Alright, and I'm live. Okay. So, good morning. You guys didn't know I streamed. I apparently stream now too. Typically start at 11 Eastern, but had some technical problems this morning and I kind of just got lazy a little bit. But I'm going to try to make an effort. But yeah, so again, these are just mostly meant for me to be chilling and to kind of do some research on the side on stuff that catches my interest. This week so far, nothing really catches my interest. Like I don't know, it's just, I know everybody's talking about the Evergrande situation right now, but, it's just, I haven't seen a lot of movement into it or in and around it because there's a lot of theories, there's a lot of talk about it, but honestly, everybody has a good sort of point of view on it, but at the same time, we're basically speculating a lot of information and we don't know what information is actually accurate because in one sense, I'll hear that, oh, well, they're still getting their payments. And then, one side will say they got the payments, the other side will say they didn't get the payments. One side says, oh, well, they got the payments, but then they were ordered to give it back to them by the government or something like that. But I don't know. A lot of stuff that I don't want to delve into right now because everybody's just jumping on the bandwagon for it. But I figured I'd just be chilling right now and seeing what happens because, again, if this thing is as big as it is, then yeah, I could see this being like a big crash situation and seeing how it capitulates and stuff like that. But right now we don't know. We don't know until a little bit more into it, and I think we need some time to pass before that happens. So yeah, anyways, so let's see what's popular this morning. So let's see. First one is H. Alterian. Let's see what.
Ethereum, Nasdaq, Aether is continuing to make huge gains after emerging as a new short squeeze favorite among investors on Reddit's Wall Street Bets discussion board and other online communities. The stock closed out the daily session up 28.6% and was up another 4% in after-hours trading as of 5:15 p.m. Eastern Daylight Saving Time. The stock closed out the daily session up 28.6% and was up another 4% in after-hours trading as of 5:15 p.m. Eastern Daylight Saving Time. The stock began spiking early this month as it emerged as a popular short squeeze candidate, but the momentum appeared to dissipate as the e-commerce and consumer product.
I have no point of study, but thanks for showing up the intro. Today's, I don't know if you've seen like on both sides, like everybody's just freaking out about that whole thing in China right now, but it's not. I'm not trying to ignore it. It's just that it's way too early to tell. Like I don't see a lot of movement.
The stock began spiking early this month as it emerged as a popular short squeeze candidate, but the momentum appeared to dissipate as the e-commerce and consumer products company's share price plummeted roughly 39% on September 14th. Now, it looks like investors are once again pouring back into Ethereum in hopes of powering the next big meme stock payday. Image source, Getty Images. So what? Ethereum's share price surged amid excitement surrounding its high-powered e-commerce service as initiatives.
Oh yeah, so how you been, Nianj? I've been seeing some of the videos you've been putting out. It's pretty top-notch. Like, I hope he's paying you for that.
Ethereum's share price surged amid excitement surrounding its high-powered e-commerce service has initiatives and strong momentum for meme stocks at the beginning of the year. However, it's been prone to volatile trading in subsequent months and hasn't managed to hold gains for long. The company does have relatively high short interest, and its number of shares sold short has steadily marched higher over the last 6 months. But recent volatility without much in the way of business-specific news suggests the stock is still squarely in the high-risk, high-reward category. Now what? Some investors have scored huge wins this year by backing meme stocks, including GameStop and AMC Entertainment, as they went on to enjoy massive. And it's possible that similar action will push Ethereum.
This is boring. Actually, I think I know what would be good. Let's go see what Burry said before he deactivated his Twitter. Oh, nope, don't want to get the MCA'd there. Inflation is all over the place. So these are some of last Michael Burry's what Michael Burry said in his Twitter. you guys are watching the VOD, which I'm surprised people actually watch the VOD for, but thank you. I didn't think I was that much of an interesting person, but apparently I'm worth watching sometimes here and there. But okay, so Burry was all on the stint about how inflation is coming, and I think the way, I think the reasoning for this is because he can't do what he originally did, which was with the swaps, because he needed access to that. He has the money, but they just don't want to deal with them anymore. So I think the way they're gonna do it is that, or I think the way he's doing it is he knows that the federal government at some point has to step in and will step in, and everybody has this whole narrative: will just keep printing more money, keep printing more money. But they're so short-sighted; they don't see the consequences of, printing more money, which is causing higher inflation, devaluation of your dollar, and so forth. And I think what he thinks is that, okay, well, the government can't let these banking institutions, these financial institutions fail, so they're going to backstop them by printing more money, regardless of the consequences afterwards. And then I think that's basically just what he's betting on. They're going to have to backstop this, no matter how much it takes, no matter how much it costs, and they're not looking at the ramifications of it. So I think that's what he's betting on, but I could be wrong. No one can really get into the mind of Burry, but I don't want to buy his Wall Street Journal subscription. Screw that. All right, but he did link this paper, and this was talking about the ETF stuff. And from what I gathered, and again, I'm not the best at reading papers like this. These papers were talking about how for every $1 you put into an ETF, it moves the price by $5 or something like that. I didn't think it was that leveraged, but apparently it says so. It said something in the lines of that, or that's just how I stand it, right? Whatever here, right here. It says, we find that investing $1 in the stock market increases the market aggregate value by about $5. So the funny thing is that's not even reflective of the true value, plus the speculative. This is all purely speculative, but if that ratio is the same. Can you imagine if we had a crash situation, how bad this would become if that was the ratio that they were at? So every dollar that you pull out, like, again, just thinking this to this logical conclusion, right? For every dollar that you pull out of this, if this is true, if for every dollar you pull out, that would mean the ETF would drop $5 in value, and that's quite significant. That means that there would be actually this could theoretically go negative. Just spitballing here, like just it might or might not, but there's a lot of weird little clauses.
We develop a framework to theoretically and empirically analyze the fluctuations of the aggregate stock market. Households allocate capital to institutions which are fairly constrained.
All right. Let's see if I can download that PDF and then. All right, I guess I have to read it. Really? Oh god. See if I can't find this somewhere. Yeah. Oh, no, it links back to this sheet. All right, I gotta call for help. I don't know where to find this, so give me 1 second. This. Oh wow, that guy has video too. this it? Oh, okay, yeah, this is it. Okay. Let's see if I can't nav this. Yes, okay, sweet. All right. Now we're getting somewhere.
In search of the origins of financial fluctuations, the inelastic market hypothesis. Xavier Gabix and Ralph Koijen.
Xavier Gabea and
Ralph Koijen. Xavier Gabea and Ralph Koijen. Financial Economics, Macroeconomics, and Growth, Monetary Economics, and Xavier Gabea and
so,
this discussion paper is issued under the auspices of any opinions expressed here are those households allocate. We develop a framework to theoretically and empirically analyze the fluctuations of the aggregate stock market. Households allocate capital to institutions, which are fairly constrained, for example operating with a mandate to maintain a
I should probably do the Devin Nash thing and pull out the little notepad.
We develop a framework to theoretically and empirically analyze the fluctuations of the aggregate stock market. Households allocate capital to institutions, which are fairly constrained, for example operating with a mandate to maintain a fixed equity share or with moderate scope for variation in response to changing market conditions.
Hold on. So households allocate capital institutions. So basically, all the normies give institutions money. That's basically the way I'm reading it right now. And
as a result, the price elasticity of demand of the aggregate stock market is small, and flows in and out of the stock market have large impacts on prices. Using the recent method.
So what this is saying is, again, to my understanding is, so stock market is small, and flows in and out of the stock market have large impacts on the prices. So obviously, because again, if this is the same 5-to-1 ratio that they're having, yeah, that would be bad. Like a minuscule amount, like not even a large whale, a small enough whale to get out could trigger everybody else to get out of the pool too.
Using the recent method of granular instrumental variables, we find that investing $1 in the stock market increases the market.
Oh, yep, that's an important point. So using the recent, no, I'm not even going to say that. So
using the recent method of granular instrumental variables, we find that investing $1 in the stock market increases the market's aggregate value by about $5. We also develop a new measure of capital flows into the market, consistent with our theory.
Okay, so paper suggests that $1 invested in the stock market increases the aggregate value by $5. Question to this would be, is it the same if you pull out $1? Would it go down by 5? Alright.
Using the recent method of granular instrumental variables, we find that investing $1 in the stock market increases the market's aggregate. We relate it to prices, macroeconomic variables, and survey expectations of returns. We analyze how key parts of macrofinance change if markets are inelastic. We show how general equilibrium models and pricing kernels can be generalized to incorporate flows, which makes them amenable to use in more realistic macroeconomic models and to policy analysis. Our framework allows us to give a dynamic economic structure to old and recent datasets comprising holdings and flows in various segments of the market. The mystery of apparently random movements of the stock market, hard to link to fundamentals, is replaced by the more manageable problem of understanding the determinants of flows in inelastic markets. We delineate a research agenda that can explore a number of questions raised by this analysis, and might lead to...
Hold on, that didn't just strike right to me, so...
We show how general equilibrium models and pricing kernels can be generalized to incorporate flows, which makes them amenable to use in more realistic macroeconomic. Our framework allows us to give a dynamic economic structure. The mystery of apparently random movements of the stock market, hard to link to fundamentals, is replaced by the more manageable problem of understanding the determinants of flows in inelastic markets.
Whoa. Research agenda raised by analysts might lead to concrete understandings of origins of financial fluctuations in the market. So what they're saying is that these movements in the stock market aren't the result of just pure randomness, but they are essentially they're hard to link to fundamentals as well, and it's replaced by more management problems understanding the terms of flows. So basically, this is telling you to just follow the money. Like as far as I can tell, like just who cares if the fundamentals say this? And granted, I've recently leaned a little bit more into the fundamentals as of this year, more so than I did ever. But here's the thing: when I was trading, like way back in the day at the institution I was trading at, you would see something, and you see this to this day, and someone stole this from me, but you would see to this day where, let's say Disney, for example, during the pandemic, whatever, right? They let off about 50,000 employees at their parks. Normal people would say, "Oh, that's terrible. They lost their jobs and all that sort of stuff, right? They need to feed themselves and families and stuff like that." Here's the thing with that: as an investor, that's actually good news for you. That would actually typically cause the stock to rise. Even though it's a bad news headline, it's actually good for you. It's polar opposite of what you think it is, because from an investor point of view, Disney's saving money by letting go of these employees rather than keeping them on payroll to not run their parks. They're not making any money from their parks to pay their employees, right? So it makes sense to cut them. Therefore, the company can save that money. So there's not hemorrhaging any money or as much anymore. So I get that, and why they say that sometimes it's hard. Well, it says it's hard to link to fundamentals, since some fundamentals can be a little bit manipulated in a sense. Like look at Nikola, and I keep throwing back to this because it's a great example. But look at Nikola, for example. Nikola said that their truck is run on an AI HTML supercomputer, and anybody that knows even remotely a little bit about coding, or even just to look at the language for HTML, you'll know that it's used to build websites. Keep emphasizing this: it's used to build websites, and it doesn't have the capability of making AI type of code. So I keep throwing back to it because it's just such a great example. But they basically lied to the investors, and the investors just ate it up despite not reading what was right in their face. But this thing is just to say follow the money, and most of the time you will see this, and this is kind of like this is kind of the premise of when I was doing research into Select Quote. They're like basically a no-name insurance company for me, at least, because I'm pretty far from them. But Hurricane Ida hit. Typically, insurance companies have a run during major disasters because they have to go down there and do damage assessment. Well, Ida died down and didn't do as much damage as people thought. So it wasn't just that they they didn't have to do any of the payouts, and I later learned that they were actually just the middleman brokerage, so it didn't really affect them whatsoever. The interesting thing about that I found was that all the executives, like the top level executives, like the CEO, the CFO, COO, and all that sort of stuff, the president, COB, whatever, all that sort of stuff, like 4 of them bought massive amount of shares into their company. Typically, what you see is they get gifted shares from the company. The company will buy up shares with the company funds and pay them out with like either options, or the shares are like gifted to them in any sort of way, and that's their payment, right? Like just look at Mark Zuckerberg. It's like he doesn't own any Facebook common shares, but he votes. It's like, okay, I'd like to give myself 5,000 or 50,000 shares of Facebook. I'm majority shareholder. I have most voting power here. I approve this. Company buys me 50 million worth of shares every month. It gets gifted to me, and I just sell it off. I'm $1 CEO. But there's a whole tax thing to go off of that in a tangent. But sorry, back to Select Quote. So yeah, all of them bought, and it was kind of weird with the timing because there was a STC investigation. Like, I'll look it up. Select Quote SEC investigation. Let's see. Yeah, so breach of fiduciary duty and suffered a loss. So basically, people were trying to sue for their losses, and there was a breach of fiduciary duty. Hang on, what was it? Breach of yeah, this was before September 21st, but this was at the beginning before this month, I believe, when I talked about this really briefly. It basically had like a 40% run from the beginning of the month. Oops. Okay. So basically, when I caught this was right around here, like in between this point. I'm just gonna use it in my disfavor here. It's like, so let's say at 1089, and it's since run about 20-30% from there or whatever, right? But again, this depends on where you got this at. But actually no, sorry, that was the end of the month for me. So yeah, 40%. 20-40%, whatever. You guys can cherry pick that all you want. So why would these, and let me go open Insider. Yeah, so these executives here bought in near the end of the month, almost immediately, because if you look at the timing there, right? So they traded on the same day and they also filed the same day. Typically, I don't know why they did this, because the thing with 4 and 4s is that they have a 3-day reporting delay. So the best time to do it is just before a weekend, because not only will you have the grace period of the 3 days or 2-3 days, whatever, when it takes to file the 4 and 4s, you'll have the weekend over because they're not going to process anything until Monday morning. So you have nearly a week's leeway to kind of, be a CEO and executive, right? But so as you can see, the CEO, the president, CFO, CEO, CFO, again, one of the directors, another director. Oh, and actually no, this is later on. This part here wasn't evident, but it was just these 4 here, and the D stands for sale for loss, whatever, blah blah. But basically, they bought shares. They bought, let's see, 5,000, 100,000, 100,000, 200,000, 200,000. They increased their holdings quite significantly after they were basically accused of breach of fiduciary duty and other violations, stuff like that. I don't know about you, but I don't know of any CEO or CFO that isn't self-interested in themselves, and they wouldn't throw their own money at something that they knew would be going down, because that's just stupid, right? But they did, and so they did this on the latest of the 31st, like I said. So this is the 31st, and this is it today. So they made quite a bit on that. So yeah, there's weird fundamentals like that, and not a lot of people are really aware of it. But all right, let's keep going.
We develop a framework to theoretically.
Already read this part.
One key open question is why the stock market exhibits so much volatility. This paper provides a new model and new evidence suggesting that this is because of flows and demand shocks in surprisingly inelastic markets. We make the case for this theoretically and empirically, and delineate some of the numerous implications of that perspective. We start by asking a simple question: when an investor sells $1 worth of bonds and buys $1 worth of stocks, what happens to the valuation of the aggregate stock market? In the simplest efficient markets model, the price is the present value of future dividends. So the valuation of the aggregate market should not change. However, we find both theoretically and empirically, using an instrumental variables strategy, that the market's aggregate value goes up by about $5. Hence, the stock market.
Whoa, okay. So that's just like an aggregate value. So it's between $3 and $8. The aggregate. It's actually estimated around $3 to $8. Hold on, I should probably put that in. Question started. If you took $1 from bonds and put it into stocks, what would happen to its aggregate value? Okay. Alright.
Hence, the stock market in this simple model is a very reactive economic machine, which turns an additional $1 of investment into an increase of $5 in aggregate market valuations. Put another way, if investors create a flow of 1% as a fraction of the value of equities, the model implies that the value of the equity market goes up by 5%. This is the mirror image of the low aggregate price elasticity of demand for stocks. If the price of the equity market portfolio goes up by 5%.
Actually, I just had a thought. If this is true, this might be some homework for you if you guys are watching, but what if you guys go and look at all the popular ETFs out there, like ARK, K, SPY, Triple Qs, Blue, all those sort of things? Take those and just look at how much they have under their roof in terms of like just dollar value, and then just divide that by 5. What would the price be afterwards, right? So that'd be quite a drop if it was to have to come back into alignment. Not saying it will.
This is the mirror image of the low aggregate price elasticity of demand for stocks. If the price of the equity market This is the mirror image of the low aggregate price elasticity of demand for stocks. If the price of the equity market portfolio goes up by 5%, demand falls by only 1%, so that the price elasticity is 0. In contrast, most rational or behavioral models would predict a very small impact, about 100 times smaller, and a price elasticity about 100 times larger. This high sensitivity of prices to flows has large consequences. Flows in the market and demand shocks affect prices and expected returns in a quantitatively important way. We refer to this notion as the inelastic markets hypothesis. We lay out a simple model explaining market inelasticity. In its most basic version, a representative consumer can invest in 2 funds, a pure bond fund, and a mixed fund that invests in stocks and bonds according to a given mandate, for instance, that 80% of the fund's assets should be invested in equities. Then, we trace out what happens if the consumer sells $1 of the pure bond fund and invests this $1 in the mixed fund. The mixed fund must invest this inflow into stocks and bonds, but that pushes up the prices of stocks, which again makes the mixed fund want to invest more in stocks, which pushes prices up, and so on. In equilibrium, we find that the total value of the equity market increases by 5.
That sounds so bad. So its most basic version can invest in 2 funds. Yes, that's true. The standard is a 60-40 split, so 60% bonds, 40% equities. Obviously, it could vary because based on how the ETF is structured. But for the most part, 60-40, sorry, not ETF, but how your portfolio is supposed to be structured, or how your financial advisor is trying to structure your portfolio. And typically it's 60-40, but most of them. Here's the thing: you should really educate yourself as much as possible to the point where you know a bit more than your financial advisor. And then test your financial advisor, because again, they might have no clue because they might not do enough research. Sometimes they're just given material, they read through it, they understand it, and but their general orders are just to sell you these products without you actually looking at what you're buying, and that can be very dangerous.
We lay out a simple model explaining market.
So. And we trace out what happens if consumer sells blah 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 into pure bond fund, mixed fund must. Yeah.
Then, the paper explores inelasticity in richer setups and finds that the ramifications of this simple model are robust. For instance, the core economics survives, suitably modified, if the fund is more actively contrarian, so that its policy is to buy more equities when the expected excess return on equities is high. Moreover, the model aggregates well. If different investors have different elasticities, the total market elasticity is the size-weighted elasticity of market participants. Importantly, the correct measure of size is the share of equity they hold. The model also clarifies how to measure net flows into the aggregate stock market, which guides the empirical analysis.
Actually, I thought of a very funny analogy for this. It seems like the way they're putting this out is that, imagine if I don't have a rubber band around me, but imagine if I had a rubber band, right? And two rubber bands. So on rubber band 1, basically I'll pull it like an inch apart or whatever, right? and it'll have that much, essentially pull force, whatever you want to say it. And then instead of what I'm trying to do is basically I will take this rubber band and I'll basically move it over to like another set of hands or whatever, right? And this set of hands thinks that instead of pulling it apart 1 inch, it could pull it out like by 3 or even 8 inches out, but average about 5 or something like that. That's the sweet spot, around 5. So it's the same rubber band. It's just that I'm pulling it a lot further than what it is supposed to originally was originally where it was from, right? I'm trying to see how far this thing can go. But the thing with if you keep stretching out these rubber bands, they're gonna snap. So I'm not saying it's just gonna like. I'm not saying pull even further and further because the ratio seems to remain the same of like 1 to 5, but it essentially just how should I put this? So yeah, just essentially imagine that thing just not being able to actually say, oh yeah, there we go. Imagine that rubber band not being able to take that 5 times pull out. This is going to be really bad if I had clips here, but imagine if you're stretching the rubber band and it can go up to 5 times, but it can't maintain that. So it'll just start tearing from one end or the other, whatever. But eventually it will snap. It can't take that tension. I think that's what this is kind of implying. But unless they can move it back, and like I said, if the inverse is true, if you take $1 out from like the SPY or whatever ETF you mixed bond equity ETF that you put it into and put it back into the bonds, will it lower that tension or will it still be kind of whatever, right? Like there's a lot of questions that pop in my head when I read stuff like this, but I should just.
If different investors have different elasticities, the total market elasticity is the size-weighted elasticity of market participants. Importantly, the correct measure of size is the share of equity they hold. The model also clarifies how to measure net flows into the aggregate stock market, which guides the empirical analysis.
Yeah. So this part here, it basically says that if different investors have different elasticities, the total market elasticity, blah blah, market participants. Importantly, the correct measure of size is the share of equity they hold. So whatever the value of that they're holding, like the SPY, whatever, pick your favorite ETF, look at all they're holding, their percentages, how many shares they have. That is the accurate measure of what the portfolio is actually worth, which leads to my other question of, if that's the case, could I predict the accurate value of that ETF by taking, again, what it's totally worth and then dividing that by the total amount of shares? And I know this is the lazy method, but taking that and dividing by the total amount of shares, which will give me the accurate price, because let's go see what the total value of SPY. No, actually, I think there's a simple way to do this. Where can I find this? Let's go research this, because if Burry's putting this out, then he's looking at all the perspectives here. Okay, so it says that it has about 374 billion in net assets. So 374 billion. Let's see, 3 hundreds, millions, billions. Sorry. Okay, so 374 billion. What's the total shares? Total outstanding shares. Okay, not type today. So 982 million. So this divided by 902.88,000, 414. Where's the SPY at now? Okay, so 442. So it's about 6.5% overvalued. I mean, like, again, this is very non-scientific. I'm not really an academic or anything like that, but that's just the way I'm kind of interpreting this. That'd be nuts if we were to fall back down to 414, because I think that would actually cause the market uptick again. You know, where the entire first time I've ever really seen this, where the market just basically just got entirely halted, like a market-wide halt. But that'd be utterly nuts if that was to actually happen again. But this time for reals,
The model also clarifies how to measure net flows into the aggregate stock market, which guides the empirical analysis. Moreover, it extends readily to an infinite horizon. In that case, the price today is influenced by the cumulative inflows to date and the present value of future expected flows divided again by the market elasticity. The empirical core of this paper is to provide a quantification of...
This is actually scratching at me. I want to call Rita down. I want to call Rita down because she'll correct me on this. Let's see if she's not busy. Oh,
what's up?
Hey Rita. So I'm reading the paper that Burry put out, the one where it said that it was basically saying that the market is actually elastic. Where I'm only in the first part of it, but I have many questions. Basically, what it's saying is that they asked.
Why can't you talk about it on?
I'm on stream.
Are you streaming?
Yes.
Oh.
Hi everybody. If anybody doesn't know, this is MartiniRita. Her channel links down below.
Can I watch your chat?
It's pretty dead, other than Neandra there. Neandra's the homie. So I had a question because...
Why don't you put your link up?
For where?
In the fucking Discord. Oh, sorry. Am I not supposed to curse? I don't know. What are your rules?
My rules are, as long as it's not YouTube TOS, so like nothing too extreme. I mean, I'm all about free speech and stuff like that. So
yeah, but it reduces your advertiser score when you curse.
Yeah, I'm getting so many advertisers right now where I with not being monetized. So Neandra says hi.
Hi, Neandra.
So I had a question in regards to this, where because it's saying that they asked a simple question of if they took $1 from a bond, what was it? A bond investment and put it into the stock market or the equity market or whatever ETFs, specifically ETFs, like a bond ETF into a like a SPY ETF. It's saying that they found an aggregate of $5 is gained in the aggregate value of the stock market versus, when you take $1 and you put it into the stock market, it's now viewed as 5. But it ranged between 3 and 8. Now, I had a couple questions into this, which is, first one is the inverse, do you think that the inverse is true?
Yes.
Because it's literally saying like, so we've measured, for every 1% gain we put in, we gained about 5% on this thing. Now, I took in consideration, it was also saying the total value you can tell the total value by actually looking at the ETF and what they're holding and what the value of that is in their thing. And when I did it, I'm not sure if I'm doing this correctly because, again, not academic. I went to this. I went to find out how much the SPY's net value is. The net assets, net assets value, whatever. The net assets are. It's about 370 billion, whatever, that sort of thing, right? And I took the outstanding shares and I divided that into that, and I got 414 as the actual price for the SPY. But the current price is at 442 right now, and that's about like a 6.5% overvaluation. But is my math and assertions correct? If that's the case, based on how.
Well, what does the paper say? Does it say it's reversed?
It doesn't say anything about the reverse. It's just saying that I'm only on the first part of it right now, but it's saying that let's see. I don't know if you're watching my stream or not, but it says that, put it another way, if investors create a flow of 1% as a fraction of the value of the equities, the model implies that the value of the equity market goes up by 5%. This is a mirror image of the lowest aggregate price elasticity for of demand for stocks. If the price of the equity market portfolio goes up by 5%, demand only falls by 1%. So that price elasticity is 0.2. And it says, in contrast, most rational behavior models would predict a very small impact, about 100 times smaller, and a price elasticity of 100 times higher. This high sensitivity of prices to flow have large consequences, flow into the market, and demands shocks effects, and expected returns in a quantitative, important way. Refer to this notion as the inelastic market hypothesis, which they're kind of taking a dump on, your favorite subject of the efficient market theory, which I think you'll like.
Efficient markets has been disproved for a long time.
Yeah,
to anyone who has a brain.
Yeah, but people still rely on it and stuff like that. But essentially, what this is implying is that, and to my understanding, if this is correct, it's like I'm taking this elastic band, and I know it can only stretch about 1 inch apart or whatever, right? But when I put this into the equity market, I'm stretching this out.
Yeah, all they're saying is that the equity markets are like a Gucci bag, right?
Yeah.
They're not a purse, any other purse, like any old purse with utility. It's saying it's a Gucci bag. So luxury goods are inelastic prices where supply doesn't correspond to demand, right? Actually, when supply goes up, when supply goes down, the price doesn't go at a linear relationship. It's like, I don't know. It's just like luxury goods, right? You're paying for something, I don't know, story or whatever.
Yeah, because the idea I thought, and I had the other night, was that if what we were discussing before is true, I think that we should apply this to all the ETFs that we look at, not the inverses, but like all the ETFs that are currently praised as the long ETF sort of situation, right? And see which one is potentially overvalued. And I'm wondering what ARCs would be, because if the SPY is about a good from 440 to 414, that's quite a significant drop. We'd be hitting the first circuit breaker. It's probably second circuit breaker. First market-wide halt and the second market-wide halt. And
you'd be down at the third one if that happened in a day.
I think the third one, it's 7.
Isn't it 440 is the 7%?
The first one's at 7. Yeah, the first one's at 7%. I think the last one's at 13%, but I can't remember because my memory's pretty fuzzy for that stuff because it doesn't occur that often. I think it was like 7, 10, and then 13 was just shut down for the day. But that's just that'd be nuts.
Yeah, but what's the catalyst?
One person just decides to sell. I mean, if this paper is accurate, right? Because if you're pulling out with the same ratio, if you're pulling out if you're pulling out that $1 from the equity market and it's consistent, then that would mean that it would go in a factor of 5, or somebody. It says 3 to 8, but it would go into a factor of 5, so it would account for essentially $5 because that's what it's pushing it up by. So every 1% it loses in terms of people pulling out, it'll actually lose 5%.
Sure, but like here's the issue, right?
Mm-hmm.
Is you've got to know when, right? When, not knowing when is the same thing as being wrong. So it doesn't matter if it does all this or behaves this way. When?
It's a great thing I pay attention to that dark pool, right, Rita?
I guess so.
I mean, this is also in supportive of like why I'm very, again, like I think that Evergrande is not over. I think that they're just letting everybody run with the narrative of whatever they want right now. And like I said, I think they're just gonna wait till they're gonna push it off. They're gonna let people run with whatever it is, and then they're gonna get tired, and then they're gonna go look at another stock or latch on to something else, and then forget about this for like the short term, and then that's when they're gonna get hit. But that's just a theory I have running right now because with the way news media works and how the year prior, I was saying that the the year leading up to last year, I saw nothing but, oh, this is the crash, this is the crash, this is the crash, and then nothing happens. And we actually go higher. And then a couple weeks later, when they stopped talking about it, then it crashed. So, but yeah. Again, I know you have your hands full, but I just wanted to pull you down for that. You can say it on. I don't really mind.
Okay. Yeah, I gotta go back, but good luck. Bye, Neandra.
Thank you, Rita. Oh yeah, it even says in the footnotes here, the price impact. The price impact is linear and symmetric. Selling $2 worth of equities, buying $2 worth of bonds decreases the valuation of the aggregate equities by $10. So yeah, that actually answers the question. So, yes, footnote 1, page 2. So yeah, that actually confirms. So the inverse is true. So for every dollar you pull out of the equity market, it'll drop by 5. That's scary.
Approach. The key idea is that we use the idiosyncratic demand shocks of large institutions or sectors as a source of exogenous variation. We extract these idiosyncratic shocks from factor models estimated on the changes in holdings of various institutions and sectors. We then take the size-weighted sum of these idiosyncratic shocks.
Also, I don't know if anybody's still watching to this 46-minute point. If you are, you're absolutely a champ, and you should probably give me a like and a sub. But what was it? Again, this is just like, this is stuff that I won't say in the recorded videos. You just have to catch the live stream for. But I should have front loaded this put there. But this is the only way I could actually get through reading some of these papers, because I already fell asleep, and then we're only on page 2 of this thing, and I have trouble focusing, as evidence of right now how long it's taking to get through this. But this is the only way I can kind of get through it. And if you guys have focusing issues, or you just can't, like, my eye wanders, like really bad ADD, like my eye wanders when I'm reading this stuff, because it doesn't click completely for me. So that's why I have the text-to-speech thing. It's literally like listening to an audiobook. You can basically be distracted to something else, but you're basically also listening and digesting the information. So that's how I get through reading these boring papers.
This way, we can estimate both the aggregate sensitivity of equity prices to demand shocks and the demand elasticity of various institutions. Importantly, the data are consistent with a quite long-lasting price impact of flows.
Yeah. And it for me, it makes sense too, Neandra, because like I can't be like all over the place and like jumping around, making all these stupid noises and stuff like that. And even if I had the interest to have a stream deck here to like play random noises, I can't do that. It's just I'm a very introverted and low energy kind of person. So like for me to jump up on my chair and basically do the XQC like monkeying around, I can't. I don't really have the energy for that. I'm old, so.
Importantly, the data are consistent with a quite long-lasting price impact of flows. Indeed, in the simplest version of the model, the price impact is perfectly long-lasting. This is not necessarily because flows release information, but instead simply because the permanent shift in the demand for stocks must create a permanent shift in their equilibrium price. We perform a large number of robustness checks, for example using different data sets. The findings are consistent across specifications, in the sense that the price impact multiplier remains around 5. We also construct a measure of capital flows into the market. We find that this measure is strong.
Yep, exactly, Andrew. This is the whole reason why I have this on. This is why I have this on demand, because like my throat gets dry and because I'm not used to talking for long periods of times, right? Oops. See, I'm mocking everything right now.
We also construct a measure of capital flows into the market. We find that this measure is strongly correlated with realized returns and survey expectations of returns, but it is only weakly correlated with macroeconomic growth. Here are 3 a priori reasons to entertain that markets would be inelastic. First of all, if one wants to buy $1 worth of equities, many funds actually cannot supply that. For instance, a fund that invests entirely in equities cannot exchange them for bonds. Many institutions have tight mandates, something that we confirm empirically. Relatedly, it is hard to find investors who could act as macro arbitrageurs. For instance, hedge funds are relatively small, and they tend to reduce their equity allocations in bad times. Second, the transfer of equity risk across investor sectors is small. This implies that the demand elasticity of most investors is quite small, or that investors experience nearly identical demand shocks, something which may be implausible. Third, a large literature estimates demand elasticities for individual stocks using a variety of methodologies, where the latest estimates of this micro demand elasticity are approximately 1. As the macro elasticity should arguably be lower than the micro elasticity. This suggests a low macro elasticity, perhaps less than 1. Consistent with this reasoning, a new literature explores elasticities for factors in the US, such as size and value, and finds elasticities of around 0.2. Hence, in light of this existing evidence, our low macro elasticity may be less surprising.
Okay, so trying to digest what I just read there. So, many institutions have tight mandates, so we know that because some institutions can't invest in certain types of funds, mostly because, let's say they're a long-only portfolio, right? So they can't invest in like short inversed funds. Some of them can, some of them can't. They can't do a lot of things to hedge themselves because they're either one of my buddies, he invested in, like, his company invests in below book value stocks. So, you know, for someone, for one of their clients, they'll find a company that they're looking at their books, and it's like, okay, well, they're actually showing this amount of money, this amount of growth, etc., however they come to that conclusion, and then they invest in it knowing that it's undervalued. Now, they'll get calls from clients which will read a headline article and say like, oh, well, I saw Apple was up like 5%. This is an example, but I'm not saying invest or anything like that. You guys make your own decisions in that. But theoretically, they'll get a call from a client saying, hey, I saw that in a headline that Apple or AMC and GME is up like 5, 10, 20%. Why was I not in this or whatever, right? And their typical response would be, because this wasn't below book value at the time when we were looking at this as well, right? And it takes a lot to research different stocks every day of the week. But they would call and complain about missed opportunities like that. But he, in the agreement and how their fund's structured, cannot put their money in those types of investments because they're too risky. They don't fall within the profile. Like, good luck trying to get past your risk team for this because they have to go through a process. If he was to bring like AMC and GME up to his risk department and say like, hey, I want to put this in, it's like, okay, sure, why? What's your reasoning? It's like, because it's a meme, right? It's gonna go to the moon. That's the typical argument you'll get on like Twitter, stock twits, whatever, that sort of stuff, right? That won't fly with the risk department. What they'll say is like, okay, what are you willing to risk on this? The entire thing. I'm going to YOLO into this thing. That's a quick way for you to get fired, and or for the risk department to never take you seriously ever again. If you say something like, I don't know, well, and again, so everybody's different. Every company's different. But like, if he went to them and said, listen, I'm looking at GME. It's sub $5, and this is part of Millennials research down below. But he noticed that their cash on hand was enough to buy their company 3 times over at the current valuation. Therefore, it was kind of undervalued. And let's say they want to allocate $1 million worth of risk in there, and if they're wrong, well, they're not going to be like, okay, fully exposed. Again, every fund is different. They might just take that $1 million worth of GME and just let it ride and just say that's the cost of doing business, whatever, right? But some other companies, what they can do is they could go into the derivatives market and buy puts against it just in case, just as a coverage, just in case, like long-term puts. So let's say that costs about $200,000 to cover that $1 million. Now, again, it's not a guarantee. It's to mostly hedge off your bets. When you're doing something like that, it's mostly to hedge off your bets just in case it doesn't pan out. And in the other scenario, yes, if GME was to go up X amount, it has to cover that the amount of puts that you bought. But if you believe, like, this is all factored and calculated into your calculation when you're pitching this to the risk team. But the risk team will say, yeah, sure, we'll like that. That's your risk. That's your reward. You guys have very tight controls under it. You know what you're doing. They want to. Their sole job is to make sure you have a good overview, you have a backup plan, you know what to do in case this thing goes awry, and yeah, they're not like fully exposing the entire fund to just like one play. I'm just using this as an extreme example because there are other stocks that don't go up as high as AMC and GE did. They go up like maybe 10%, and that's the highest amount or whatever, right? But yeah. So where was I? So for instance, hedge funds are relatively small. They hold less than 5% of the equity market, tend to reduce their equity. There are some hedge funds that will hold both sides. There are multiple different types of market maker strategies, hedge fund strategies to make money off of just being essentially delta zero. Sorry, no, beta zero, beta weighted, whichever you want. Sorry, no, not beta, delta. Well, yeah, whatever. You know what I mean? Like they're just basically perfectly long and perfectly short. Quite small. Blah, blah. Yeah. All right.
Suppose that the inelastic markets hypothesis is true. Why do we care? First, investor-specific flows and demand shocks are quantitatively impactful. As a result, one can replace the dark matter of asset pricing with tangible flows and the demand shocks of different investors. This suggests a research program in which determinants of asset prices can be traced back to measurable demand shocks and flows of concrete investors. By studying the actions of these investors, we can infer their demand curves, and theorize about their determinants. If equity markets are indeed inelastic.
So basically what this is saying is follow the money.
If equity markets are indeed inelastic, several questions that are irrelevant or uninteresting in traditional models become interesting. For instance, if the government buys stocks, stock prices go up again by this factor of 5. This may be useful as a policy tool.
Ooh. For instance, if the government buys stocks, stock prices go up again by this factor of 5. And if you guys remember my previous research in Japan, the government actually got directly involved in the stock market. They actually took directly equity into their own stock market.
This may be useful as a policy tool, a quantitative easing policy for stocks rather than long-term bonds. It may also be used to analyze previous policy experiments in Hong Kong, Japan, and China, and give a quantitative framework to complement the previous qualitative discussions of policy proposals of this kind. Farmer, Brunnermeyer. Also, firms as financiers materially impact the market in our calibration. Prior research showed that firms react to price signals, such as in their decisions to issue dividends or raise funds in stocks versus bonds. Now we can quantify how firms' actions impact the market. For instance, stock buybacks can have a large aggregate effect. Suppose that the corporate sector buys back $1 worth of equities rather than paying $1 worth of dividends. In the traditional Modigliani-Miller world, the market value of equities does not change at all. In contrast, in an inelastic world, the value of equities goes up, by a tentative estimate of around $2. As a naive non-economist might...
I'm going to reframe this, it's probably wrong, but... So when they do the stock buyback, right, it goes from 1 to 2 rather than paying out the dividends. The thing with buybacks is you're basically lessening the total share count, and in order to raise the value of your current shares that are held. And this is not by any means like a stocks. This isn't like diluting your shares. This is actually increasing the value of it. Now, let's just replace that really quickly when it says that the tentative estimate is around in the last the value of equities goes up by $2. Imagine that with just instead of the equity value and source, replace that with the word leverage. So you go from 1-to-1 leverage to 2-to-1 leverage, which would actually cause sharper volatility and higher price swings if something was to happen. Granted, the intent is to raise the value of current holdings. It just basically becomes more dangerous, and this is something that Burry told Elon. It was something Burry told Elon to do because, and Rita had to break this down for me, where if you have a finite amount of shares and they're being super overvalued or something like that, and essentially if the stock market was to drop a certain percentage because they're holding so much of like Tesla will drop a significant amount more, and it will lay into each other because of how highly leveraged the ETFs that invested into Tesla have been. It's like an anchoring kind of process. Like, when the SPY drops down, it'll bring Tesla down even more, and then when Tesla gets brought down more, it'll bring down the SPY more, and so forth. Right? They're both weighing each other down. All right, let's see. And yeah, that leverage doesn't help it. So it just makes the anchor a little bit heavier if they're doing the stock buyback. It's my interpretation.
As a naive non-economist might think, if firms buy shares, that drives up the price of shares. A rational financial economist might say that this is illiterate. But the naive thinking is actually qualitatively correct in inelastic markets. Hence, potentially, as share buybacks account for a large portion of flows, corporate actions account for a sizable share of equity purchases, and therefore of the volatility and increase in the value of the stock market. This corporate finance of inelastic markets is an interesting avenue of research. If markets are inelastic, then macro finance should reflect that. Accordingly, we construct a general equilibrium model in the spirit of Lucas where there is a central role for flows and inelasticity. It clarifies the role of demand shocks and flows, the determination of the interest rate, and shows how to augment traditional general equilibrium models with flows in inelastic markets. That makes those models more realistic, and better suited for policy. This model may serve as a prototype for models enriched by inelasticity. Indeed, it calibrates well, and replicates quantitatively the salient features of the stock market, such as the volatility and size of the equity premium, the slow mean reversion of the price-dividend ratio, and the ability to predict stock return with the price-dividend ratio at different horizons. We also show how the model can be used to match the strong correlation between prices and subjective beliefs about long-term growth, Bordallo et al. Even if fluctuations in beliefs have only a modest impact on actions, as the resulting flows are amplified in inelastic markets. We conclude that our general equilibrium model with inelastic markets is competitive with other widely used general equilibrium models that match equity market moments, be it via habit formation, long-run risks, or variable rare disasters, WACTR. In addition to proposing a new amplification mechanism, its main advantage, as we see it, is that it relies on an observable force, flows in and out of equities.
Yep,
we also show how to connect flows to the stochastic discount factor approach. The flows are primitive, and the SDF is a bookkeeping device to record their influence on prices. This model could be helpful to get correct risk prices in macroeconomic models, including their variation due to flows.
Hold on, I'm going to note that for later, because I don't care much for a lot of these things. Stochastic discount factors. SDF is a bookkeeping device to keep record. Oh wait, to record their influence on prices. Model could helpful to get correct risk prices macroecon models, including their. So it's basically to tell how much your ETF or whatever you're investing into would be affected by this money coming in or out.
One limitation of our study is that we postpone to future research the detailed investigation of what determines flows in the first place. Instead, we provide descriptive statistics showing they. The estimate is tentative, in part as it relies on estimates of the rationality of the consumer after the buybacks.
Yeah, this is saying that you have to consider what the individual consumers would do after the stock buyback, and it's hard to predict because people are very, very irrational.
Correlate sensibly with other variables, such as prices and measured beliefs. The reason is chiefly that this would be a standalone paper. But we think it is quite doable, and indeed we are working on this. Rather than studying shocks to noise traders abstractly, we replace them with investor-level flows and demand shocks that may be easier to understand.
So follow the smart money.
Indeed, episode by episode, one can ask questions such as why did firms lower their buybacks, why did pension funds buy, or why did hedge funds sell? Literature review. Our paper is about the macroelasticity, in contrast to the microelasticity estimated in the literature, including Schleifer, Harris, and Gurul, Wergler and Zurovskia, and Duffy. We summarize the evidence on existing elasticity estimates and we build on the insights of DeLong et al., who write an equilibrium model in which noisy beliefs create demand shocks that move the market and the equity premium. They discuss a rich set of qualitative ideas, some of which we can formally analyze and quantify, such as the failure of the Modigliani-Miller theorem and the notion that if most market participants passively hold the market portfolio, prices react sharply to flows.
That's interesting. So they discuss a rich set of qualitative ideas, some of which can formally analyze and quantify, such as the failure of the blah blah. That last part is actually interesting. So the notion that if most market participants passively hold the market portfolio, prices react sharply to flows. I guess it sounds like they're just saying like most of the people are the bag holders, and if they refuse to sell, the prices of that ETF could react sharply depending on what the smart money does thing. Which, I mean, the smart money is managing a lot of money with a lot more weight than your average investor. So again, follow the money, but now this seems to be implying follow the smart money, which, I mean, it's not outside what I already do.
DeLong et al. Dealt with these issues qualitatively, but, influenced by it, a literature has studied the impact of mutual fund flows in the market.
Give me 1 second. Where are you? I don't know how you do it, Millennial, but anyways.
DeLong et al. Dealt with these issues qualitatively, but, influenced by it, a literature has studied the impact of mutual fund flows in the market, for example Warther. In addition, an active literature studies the impact of mutual fund and ETF flows on the cross-section of equity prices, for instance Frazanai and Lamont, Liu, Ben David et al. Yeah. One innovation of our paper is to provide a systematic quantitative framework to think about this, to include all sectors, and to think about causal inference at the level of the aggregate stock market via give. Yusker and Johnson use high-frequency order flow data for S&P 500 futures to show that about half of the price variation can be attributed to flows shocks. Moreover, they find these shocks to be permanent over the horizons that they consider. A few papers have modeled how flows might be important, examining general flows in currencies. Greenwood et al., Gurinchas et al., slow rebalancing mechanisms in currencies, and equities, who emphasize flows coming from the supply of shares by firms, or switching between types of stocks, V&Os and Woolly. However, we believe we are the first to conceptually and quantitatively explore the elasticity of the aggregate stock market using a simple economic model to link data on total holdings and flows to fluctuations in the aggregate stock market. We also provide the first instrumental variables estimate of the elasticity of the U.S. equity market. Kamenho et al. Provide a partial equilibrium model of exchange rates with flows, quantified with the give methodology developed for the present paper and spelled out in 3A. Growing literature studies elasticities in global financial markets, see for instance Dierker et al. And Caro and Wang et al. 4C. Also Edelin and Warner. 5D. Yusker and Johnson study a system of equations in which flows may impact returns and returns may impact flows. To identify price impact, they rely on identification via heteroscedasticity as in Rigaud-Bon. As only the demand shock in futures markets is used, and not in cash markets, we cannot directly translate the estimates into multipliers. However, under the assumption that flows in cash markets are highly correlated with flows in futures markets.
Duh. Okay. That's so stupid. I thought this would be somewhat obvious by now, but like the futures market mostly leads the spot market, or the cash market. So obviously, why does everybody always refer to the futures? This is why everybody always refers to the ES or E-mini, whichever you want to pick. The futures will influence what the SPY does. That's basically what they're saying. That's basically what they're implying here. And let's see, what was it? Oh yeah, that's basically it. So, I mean, that's kind of an obvious. That's why they always, like when I started, that's why they say to pay attention to the futures when you're trading something, because that's that's indicative of what's going to happen.
A related
Not
literature
always,
finds convincing evidence that supply and demand changes do affect prices and premia in partially segmented markets, for bonds, for example as in Greenwood and Vayanos. Greenwood and Hansen, and Vayanos and Vila, mortgage-backed securities. Or options, with models which typically feature CARA investors and partial equilibrium. Here our focus is on stocks, while our model is quite different from the models in that literature and is also developed in general equilibrium. Our work also relates back to the work on flows and asset demand systems by Brainerd and Tobin and Friedman, among others. This literature faced two important challenges that we address. First, data on asset holdings were not as readily available as they are now, and, second, there were no obvious methods to identify the slopes of asset demand curves. We share with Koijan and Yogo and Koijan et al. Our reliance on holdings data by institutions, and the desire to estimate a demand function. We are mostly interested in the equilibrium in the aggregate stock market, as opposed to the cross-sectional focus of Koijan and Yogo, and we emphasize the role of flows, and the dynamics of prices and capital flows over time. Using a similar modeling strategy as in Koijan and Yogo estimate a global demand system across global equity and bond markets to understand exchange rates, bond prices, and equity prices across countries. We also relate to the literature on slow-moving capital, Duffy and Strolovici, Morera, Lee, providing a new model for price impact with long-lasting effects, and an identity. Finally, part of our contribution is a new model of intermediaries, with a central role for flow. Much more distant to our paper is the theoretical microstructure literature. There, inflows cause price changes, but crucially those inflows do not change the equity premium on average, and hence do not create excess volume. In contrast, in our paper, inflows do change the equity premium, creating excessively volatile prices.
Okay, so it's basically what we were saying before. They just kind of confirmed it there. It said, in contrast, our paper inflows do change the equity premium, creating excess volatile prices. So, again, remember how I was saying it's that rubber band that keeps stretching back and forth, and it just becomes. We replace the term of value with leverage. It seems that they're just super over leveraged, and it can create it can create that scenario where, like, yes, if one goes up excessively, it brings everything up. The rising tide lifts all ships, but when the tide lowers, it lowers all ships as well. And what this is saying is that even though they're differently weighted, they could be a little bit more extreme. Like, just picture the boats moving up and down, but they have different cargo weights on them at different times, and sometimes it gets heavier, sometimes it gets lighter, but most of the time it's really heavy.
Outline Section 2 gives some simple suggestive facts on equity shares and potential macro arbitrageurs such as broker-dealers and hedge funds. It also summarizes the existing literature on elasticity estimates. Section 3 develops our basic model of the stock market. It lays out the basic notions, and defines clearly elasticity and its link with price impact. It also gives the theoretical framework that we take to the data. Section 4 contains the empirical analysis, including with an instrumental variable estimation of the aggregate market elasticity. Section 5 provides a general equilibrium model that helps to think about how everything fits together. It specializes the basic model of Section 3 as it endogenizes the interest rate and links cash. Section 6 discusses how the effectiveness of government policy and corporate finance change with inelastic markets. Section 7 provides a conclusion and thoughts about the research directions suggested by the present approach. The appendix contains the basic proofs and details. The online appendix.
Oh my god, this is so much math here. So, E for expectation, C for equal weighting. You guys can look at this formula on your own time. I took advanced math, and I purposely failed it because I didn't want to take, like, calculus or any of that advanced stuff in high school. So I just wanted to be average and get through it.
2 Data and suggestive facts on equity shares and flows. In this section we document several stylized facts and discuss how they are related to our model and to traditional, elastic asset pricing models. These facts are meant to be no more than suggestive. The core empirical results are in Section 4, in which we try to, after discussing the data construction in Section 2.1.3, that is, we ask, who are the deep-pocketed arbitrageurs that could make the aggregate stock market elastic? This question relates to the work by Brunnermeier and Nagel, who show that hedge funds did not provide elasticity to the market during the technology bubble in the late 90s. 2.1 Data sources and construction.
Hold on, that's important actually. Deep pocket. Who are these deep pocket arbitrageurs that can make the aggregate market elastic? Question relates to the work by. We show that hedge funds did not provide elasticity to the market during the technology bubble in the late 90s.
We summarize the data sources that we use.
That's something interesting to mark for later.
We summarize the data sources that we use and define some of the key variables. We leave a detailed description for Appendix C. We use sector-level data from the flow of funds on holdings of equities and bonds as well as flows into both asset classes. Flows are differences in levels adjusted for mechanical valuation effects. We compute total bond holdings as the sum of treasury and corporate bond holdings, and analogously for flows. As the FOF reports combined values of holdings and flows of foreign and U.S. assets, we adjust these series. We assume that the flows transact at end-of-period prices. The sample is quarterly from 1993 to 2018 and we use the June 2019 vintage of the FOF data. We use monthly disaggregated data on assets under management, the share invested in U.S. equities, and flows from Morningstar for mutual funds and ETFs that are domiciled in the U.S. and that have the. We select the funds in Morningstar's U.S. category groups U.S. equity, sector equity, allocation, and international equity. For state and local pension funds, we use data from the Center for Retirement Research at Boston College. We use data on the share invested in equities and fixed income as well as target holdings in equities and fixed income. State and local pension funds report once a year. We use a fund's actual and target allocation to equity and fixed income and scale it so that the sum of the shares equals 100% for each fund. We use disaggregated data on equity holdings by institutional investors via Form 13F filings. 6 data of different vintages can be downloaded from this website. 7 we
remove funds. Funds. Oh yeah, so mutual funds. So they're not taking any ETFs holding mutual funds because it's like you have the asset and then it's put into a portfolio and sold it to you as like an ETF or whatever. But then it's literally actually the way I think of it is it's like you're buying an asset that holds you're buying an ETF or mutual fund holding an ETF or mutual fund. So you're basically like about 3 times removed from the situation, which is incredibly fucking stupid because, again, if you guys don't know this, if you don't own that underlying asset and you just own the ETF, you don't actually own any sort of shares in that company. So if that company was to default, for example, or go into massive bankruptcy, you don't get that protection because you're essentially not actually holding that specific stock. You're holding the portfolio that holds that stock. In terms of people getting paid, let's say they had a stupid amount of cash there. They could pay out all the priority ones, so like preferred shareholders, bonds, the lenders, everybody else, and you actually get something as the common stockholder. Let's say there's enough. Theoretical situation, typically there's not enough, but you would actually get something because you actually own that share directly. But if you're owning the ETF and the ETF tanks because that thing tanked the entire ETF, you don't get jack at all. The fund the fund that made the portfolio will get something, probably not as much as you invested into it, but you get absolutely nothing. So there's that little underlying risk there that not a lot of people are really aware of.
8. We omit a small number of fund quarters in which the U.S. equity share exceeds 300% or is lower than minus 300%, as these may be data errors. Figure 1, Equity Shares. The left panel of the figure plots the equity share in 1993 and in 2018 by institutional sector using flow of funds data. The right panel displays the valuated average equity share of mutual funds, ETFs, and state and local pension plans. The equity share of the different institutions are averaged using the relative equity size of each investor. The construction of the data is discussed in Appendix C. Households mutual funds foreign sector. We use quarterly data on real GDP growth from the St. Louis Federal Reserve Bank FRED database, Series GDPC1. Data on returns with and without dividends are from the Center for Research in Security Prices. We use the monthly, valuated return with and without dividends to compute the monthly dividend payment. Lastly, we use survey expectations of returns from Gallup, as also used by Greenwood and Schleifer, who use the fraction of investors who are bullish minus the fraction of investors who are bearish. We update their data, which starts in 1996.Q4 to 2018.Q4, and the resulting series has some gaps. 2.2 Institutions often have a quite stable equity share. As a point of reference, we summarize in Figure 1 the evolution of ownership of the U.S. equity market from 1993 to 2018 based on FOF data. During the last 25 years, equity ownership moved from households' direct holdings to institutions. The figure understates that.
So this is what this is saying, is that basically a lot of people that used to manage their own monies individually are moving into trusting the big banks and their ETFs and stuff like that. So, and again, I've never been a huge fan of going into a lot of ETFs or just like having them manage my money, because I have a sense of how it's I have a little bit of a sense of how it's done, and they don't have my best interest at heart. I'm not saying all financial advisors are bad. If you guys are in the States, find a financial advisor that is also a fiduciary, and not only that, a fiduciary with all the investment products that they are trying to sell you. Because if they're not, then they don't have the best interest at your best interest at heart. They're just trying to sell you because they're going to collect a commission on that. So something to be very cognizant of.
During the last 25 years, equity ownership moved from households' direct holdings to institutions. The figure understates this trend, as the household sector in the FOF includes various institutional investors such as hedge funds and nonprofits. Broker-dealers, who received much attention in the recent asset pricing literature, hold only a small fraction of the U.S. equity market. This limits their ability to provide elasticity to the market. For some of these sectors, such as mutual funds, exchange-traded funds, and pension funds, we have investor-level data on equities and fixed income holdings. In the right panel of Figure 1, we plot the equity share. We aggregate different investors in a given sector using the relative sizes of their equity portfolios as opposed to assets under management, consistently with our theory. To appreciate the importance of this difference, consider an economy with only pure equity and pure bond funds that have the same amount of assets under management. The equity-weighted equity share equals 100%, while the asset-weighted equity share equals only 50%. As the relative size of equity and bond assets move, so will the asset-weighted equity share. Yet, the equity-weighted share will be a constant 100%. It is the equity-weighted equity share that is relevant per our theory. The plot shows that equity shares are quite stable over time for broad classes of investors. This is consistent with many institutions having a rather rigid mandate to maintain a stable equity share.
So there, if I'm understanding it correctly, they're saying that, if you pull $1 out from one of the bond market funds and you put that dollar into the equity market, it should be 1 for 1, not this whole 1 for 5 situation that they're seeing.
The plot shows that equity shares are quite stable over time for broad classes of investors. This is consistent with many institutions having a rather rigid mandate to maintain a stable equity share. In the model that we introduce in Section 3, this mandate rigidity will be captured by a low elasticity of funds' asset location to the expected return on equities. In recent work, Cole et al. Show that a large fraction of households also have a high average equity share at 79.2% with little variation over time. This stability is in part explained by the introduction of target date funds. 2.3 In search of macro arbitrageurs. Figure 1 shows that the equity shares of large groups of investors, such as mutual funds, ETFs, and pension funds, are stable over time. As the foreign sector consists of similar institutions, this fact naturally raises the question of who carries out arbitrage across asset classes or, equivalently, which group of investors aggressively times the market. In the survey that we discuss in the introduction, 2 investor sectors are frequently mentioned: hedge funds and broker-dealers. Point 10. As Figure 1 shows, broker-dealers are very small and hold less than 0.5% of the equity market directly. So while perhaps important for the micro-elasticity, broker-dealers are not well positioned to absorb large equity flows over longer periods of time. The hedge fund sector is also quite small, with holdings below 4% of the equity.
Okay, so I don't know who's still with me in this recording right now, but the hedge fund sector is also quite small, with holdings below 4% of the equity market. That whole narrative of hedgies are bad, hedgies this and stuff like that. They have very little exposure, according to what they're finding.
The hedge fund sector is also quite small, with holdings below 4% of the equity market in long positions going into the financial crisis. First, hedge funds sold a large fraction of their equity holdings during the financial crisis, averaging to 3.06% per quarter from 2007 Q3 to 2009 Q1. Given their small size, this corresponds to selling on average 0.1% of the market each quarter. Redemptions and leverage constraints explain about 80% of this decline in equity holdings. Second, flows across sectors are small. Ben David et al. Decompose the market into hedge funds, mutual funds, short sellers, other institutional investors, and non-institutional investors. Measured as a fraction of the market, these investor sectors sell or buy on average just 0.25% of the market per quarter. We extend these calculations using data from the FOF for the technology crash in 2000 to 2002 and the 2008 global financial crisis in Appendix D.3.
I see why Burry referred to this paper, because it's literally how he sees the market right now.
In summary, many funds appear to have fairly tight mandates. Hedge funds do not appear to arbitrage the aggregate stock market and amplify demand shocks during severe downturns, and flows between sectors are small. The small flows across sectors has implications for the properties of demand shocks, which are shocks to investors' beliefs or risk appetite, given the elasticity of demand. The signature of elastic demand is that disagreement among investors is associated with large flows and quantity movements. As flows are small, theories featuring elastic demand imply that investors should agree almost perfectly in their beliefs about expected growth rates and their riskiness, and also have similar risk aversion. In inelastic markets, in contrast, there can still be large common shocks to beliefs. 9. Their sample appears to be representative of the middle 80% of the retirement wealth distribution of retirement investors between age 25 and 65. 10. While a large literature explores the microelasticity of hedge funds, we are interested in their market elasticity. In the FOF, hedge funds are part of the household sector and we cannot study them separately using these data. Instance as during the 2008 financial crisis, but there is much more scope for disagreement. 11. This second interpretation of financial markets may be more consistent with the data on beliefs, which points to significant fluctuations in disagreement over time. 2.4 The micro.
So basically they're talking about the bulls versus the bears.
2.4 The micro and macro elasticity of markets, summary of existing evidence. This paper is about the macroelasticity of the market. This is in contrast with the very large literature that studies the microelasticity of the market. In Panel A of Table 1, we provide a summary of recent estimates of the micro multiplier, which is the percent change in prices when an investor purchases a certain fraction of the shares outstanding in a...
So now they're talking about that, if you 1% affecting 5%, 1% influencing about 5% now.
12. While there is a range of estimates, the order of magnitude of the multiplier is around 1. That is, buying 1% of the shares outstanding of a given stock makes its price increase by around 1%. In addition, several recent studies have looked at the factor level multiplier, which is the price impact if an investor buys a
factor level multiplier, otherwise known as leverage.
In addition, several recent studies have looked at the factor level multiplier, which is the price impact if an investor buys a fraction of the shares outstanding of a cross-sectional factors such as size or value. We report those estimates in Panel B. The studies report a multiplier that is substantially above 1 and closer to 5. In Panel C, we report recent estimates of the macro multiplier, the parameter of interest in this paper, for the Chilean and Chinese stock markets. Once again, the multiplier estimates are well above 1. Equivalently, the macro elasticity...
Wait, what? Macro multiplier, the parameter of interest in paper for the Chilean and Chinese stock market. Once again, the multiplier estimates are well above 1. So it's not just so obviously this is not just to the US, but it's implying Chinese stock market. It's also, they're also quite leveraged.
Taken together, the existing evidence in the literature suggests a micro multiplier around 1, and a factor 11. To make this more concrete, using the notation of the next section, consider the simple decomposition of demand. Kit equals zeta p plus fit. If markets are as elastic as in standard model, as the volatility of this leaves little room for disagreement among investors, even though this is widely documented in beliefs data, as the signature prediction of a model with elastic markets and belief disagreement is the presence of large flows coupled with small price changes. When markets are inelastic, say zeta equals 0.2, then fit equals kit plus 0.2p. Demand shocks still contain a large common component. 12. Also, the empirical market microstructure estimates of price impact are larger than what we find. The price impact that the microstructure literature finds is a factor of about 15, Frazani et al., which may make our estimate of 5 seem moderate. Microstructure results are...
That's terrifying. Which makes our estimate of 5 seem moderate. So, if you didn't want to pucker your, to give you an idea, most brokerages will only give you 3-to-1 leverage on your margin accounts. You remember Bill Huang? the that investor, the I think they called him the Tiger of Asia. I can't remember, but this guy had a leverage of 5-1, and look what happened to, let's say, Viacom when he had to liquidate because he was getting margin called. This is what happened to Viacom stock. So he was leveraged 5-1 and went from a peak of 100 down to 39 something, so about a 60% drop. This was just one of his holdings. I tell you, that's if this doesn't scare you, I don't know what would. But a 60% loss is kind of terrifying in my opinion.
Which may make our estimate of 5 seem moderate. Microstructure results are.
And yeah, that this is like, you know, he was at the same type of leverage of 5-1. Imagine something greater in Asian markets, right?
At first glance, values in this range might appear to imply a small price impact. However, they work out to a large price impact multiplier of equals 15, with 250 days of trading in a year, and a 100% per year turnover. The trade in our example would represent a purchase of 5% 250 equals 0.01% of the market capitalization of a stock, so that the impact of 0.15% on the price results in a multiplier of 15. The interpretation of this kind of microstructure estimates requires some caution, as we discuss in section G.5. To sum up, a microstructure estimate of May 15 have the following interpretation: in inelastic markets with a microelasticity equal to 1. A large market-wide desired trade is on average split into 15 smaller trades executed over time, by one or several institutions collectively. These microstructure estimates are also themselves to be taken with caution, since identification tends to be difficult as trades are not exogenous to prices. Using high-frequency data with a give-based identification may be a promising way to enrich identification procedures in microstructure. Table 1, Multiplier Estimates in the Existing Literature. The table reports multiplier estimates in the existing literature for individual stocks, factors such as size and value, and the aggregate stock market. The multiplier is defined as the percent change in price. We discuss footnote 12 in Appendix G.5 how to interpret the trade level estimates of Frazani et al. And
Damn, that's nuts. Some of them go up 15 times.
How do these estimates compare to the elasticities implied by standard asset pricing models? It is well known that the microelasticity in standard models is very large, of the order of 1000 or above. This implies that the micro-multiplier is essentially zero and demand curves are virtually flat. Based on the estimates reported in Table 1, the models are several orders of magnitudes off in terms of the microelasticity. Our focus is on the macroelasticity and we compute it for various asset pricing models in section F.4.13. The summary is that in traditional, elastic asset pricing models the macroelasticity is around 10 to 20, leading to a multiplier around 0.1 to 0.05 as any two stocks are closer substitutes than stocks and bonds. The micro multiplier is much lower than the macro multiplier in standard asset pricing models. However, the micro multiplier as estimated in the literature is already an order of magnitude larger than the macro multiplier implied by standard asset pricing models. The macro multiplier estimates are even larger, which deepens the disconnect between existing estimates and asset pricing models.
So that basically just says that current valuations are blown out of proportion. So basically, my interpretation of it is basically stocks. What they're implying is that stocks would be overpriced, or say the asset in question is significantly overpriced for what its actual value is worth.
The profession's view on the macroelasticity and the underlying mechanism. While the disconnect between the empirical estimates and asset pricing models follows from the existing literature, these facts have typically not been targeted in macrofinance asset pricing models. In fact, as we will discuss now, this evidence does not appear to be widely known or accepted in the profession. 13. We discuss the elasticity. We quantify this via two surveys. We provide a detailed discussion in section E and summarize the main insights here. We conducted a first survey by putting out a request via Twitter to complete an online survey. In addition,
let's go check that out. Damn it. Alright, I'm not logged into Twitter on this one, so hashtag econ Twitter. Wow, it's still going. I guess it's just a common enough tag. Don't care about that. Random videos, blah. Yeah, it's not really saying anything to me. All right. Probably close some of these.
In addition, we asked participants of an online seminar at virtualfinance.org to complete the same survey, this latter audience being naturally more representative of the population of academic researchers in finance. Both surveys were conducted before the paper was available online and before the seminar was conducted. We received 192 responses for the Twitter survey and 102 responses for the survey connected to the finance seminar. The survey question was the following: if a fund buys $1 billion worth of U.S. equities, slowly over a quarter, how much does the aggregate market value of equities change? The answer given in this paper is times $1 billion. Where is the macro multiplier, which we estimate to be around
5, so they had
equals 5. In both surveys, the median answer was equals 0. Surveyed economists, logically enough, rely on the traditional asset pricing model in which prices are unperturbed by flows. The median positive answer was M equals 0.0114. Hence, surveyed economists' views are in line with the traditional model, but far from the estimates reported in the empirical literature, and the new estimates we provide. We also asked about the sectors supposedly providing elasticity to the market to be able to explore the mechanism. The two most common responses were hedge funds and broker-dealers. As discussed before, those sectors are unlikely to provide elasticity to the aggregate market, in particular during times of stress. 3. The inelastic markets hypothesis, theory. We now provide a model that we think is more realistic to think concretely about the determinants of stock demand, and about how flows impact prices. It is highly stylized, but will be useful to think about the determinants of elasticity and to guide empirical work. We start with a 2-period version, and then proceed to an infinite horizon variant. 3.12 period model. There is a representative stock in fixed supply of shares.
Okay, that's okay, so what was I?
Share.
Oh, there we go. Alright, the reason I'm making that face is because not specific to this, but something else caught my eye, which was, again, we're still on, like, you know, watch for crashes and stuff like that, but this thing and this thing came across my eye. I am doing research on the side as well while doing this, multitasking, you know. But track the investment results of the U.S. dollar denominated. Okay, yeah, this is something I'll have to bring to Rita later. If you guys don't know, MartiniRita, the lady that was here earlier, she also runs a stream on Twitch. Links down below. You guys should check her out as well. I usually hang out there with her as well. She's better at making sense of all these papers and stuff like that. So if I go over something and I don't get to you, you can ask me there on her stream. I'm there live as well, you know, 4 days a week as well, and she could probably give you a more elegant response. I'll be fair. Things were never explained simply to me. Still not explained simply to me, and it's just something you kind of have to deal with in this type of world because it's not welcoming. It's not very welcoming to new people. But yeah, I should really show her that later. How long have I been live? Let's see. Hour and a half. All right, so I'm probably just gonna call it here because I actually went over half an hour. I'm just trying to see what my endurance level is like. I could go longer, but I kind of want to bring this over. It's almost 1 o'clock here, so it's page 12. Okay. Yeah, I'm gonna keep reading this off stream. You're more than welcome to grab this PDF. It'll be in MartiniRita's Discord, which again, link down below. Sunday video, I'm not sure what I'm gonna do on it yet. I'm still doing the blank that I just buy series so far right now because I want to have cash on hand for when and if this thing is going to essentially come collapsing down. And yeah, check out the links below. Follow me on all the other socials. I started a Subscribe Star as well. I will be using some of those funds to hire an editor because there's a lot that is on my plate as well, and I would like it to have a secondary editor to help me edit some of the things, do some graphics as well, do some thumbnails and stuff like that. It's just to make my life a little bit easier and to provide a better quality of video towards you guys. It also, I honestly don't think it's going to really take off, but you know, it'd be nice to have a secondary editor, and if I got a little bit, I can just kind of pay the editor, pay a second editor, as well as have it supplementing, give him more than he's worth. If he's worth his salt, like Neander is, I can give him a little bit more than what the standard rates of editors are getting paid nowadays, and give you guys a better quality product. But I'm rambling at this point. Socials, blah blah. Yeah, subscribe, like, follow, leave a comment, subscribe, start, leave a donation, which is Patreon alternative. But yeah, that's all I have to say, and I guess I'll catch you guys. I'm gonna do this weekly, every Friday, just to dip my feet into live streaming. But yeah, I will, Leandra. Right now, it's not too overwhelming enough for me right now. But when I do get some subscribe stars, I'm definitely gonna keep you in mind and hit you up, because I like the quality of your work, and yeah. But other than that, I'll leave you guys with this. Just remember, just because you're a day trader doesn't mean you have to trade every single day. And see you later.